Investing short-term or investing long-term? What's the difference? In this installment of our classroom series on investing basics, we're going to be looking into just that. The time frame for your investing can have a big influence on your investing strategies, including how much risk to take on. Let's get into it. Welcome to the second installment of our Investing Basics classroom series. In our first class, we looked at the risk versus return spectrum and how that can impact your investment strategies. Today we'll be doing something similar, except we'll be focusing on short-term versus long-term and how that can impact your investment strategies. Whether you're focusing on short-term or long-term investing is going to depend on your financial goal. What are you investing for? Once you have your goal, then you can start coming up with a financial plan. An example of a short-term investment would be saving up for a home that you plan on purchasing in the next few years. Your goal is to buy a home and your time frame is less than 5 years, so that would require a short-term financial plan. Why 5 years, you might ask? We'll get to that number a little bit later. On the other side, maybe you're planning on saving for retirement, which could be decades from now. That would require a long-term financial plan. Or you might be something in between. Maybe you manage a university endowment fund where you have long-term goals like maintaining the principal of the endowment, but you also have short-term goals like distributions to pay for student tuition each school term. In that case, you might want to have a bit of a hybrid financial plan. At this point, I do have to give you my usual disclaimer, for the sake of the longevity of my company, of course. I am not a certified financial planner. This video is not financial advice, and you are responsible for your own financial decisions. Now that we have that out of the way, let's continue. Let's take a look at some of the different investment categories we have on our short-term versus long-term spectrum. On the left-hand side here, we have short-term investments. These are going to be the less risky investments because you would need the assets within a few years. And on the right-hand side, you have long-term investments. And these are going to be the assets that are a little bit riskier because you won't need them for more than 5 years. So for the short-term investments, we're looking at things like a high-yield savings account or a money market account. A certificate of deposit or CD could also fall into this category. The yields on these are so low that some people would hardly call them an investment. They can barely keep up with low inflation. But the point here is that these are for funds that you will need soon and don't want to take the risk of losing them before you realize your short-term financial goal. Next up are bonds. Government bonds and corporate bonds. Government bonds are typically going to be more safe than corporate bonds, especially if you're getting U.S. Treasury bonds. But the yield will be lower. Corporate bonds are going to be riskier, but have the potential for higher yield. And then on the far right, we have stocks, the riskiest of these four, and are what I would consider a long-term investment. And there is a particular reason for why I'm calling it that, which we'll get into shortly. Some other honorable mentions would be real estate, which I'm not going to get into much today as there are so many ways you can approach real estate investing. If you are interested in a video on that, please leave a comment below and let me know. If enough people would like to see it, we can definitely do that. In addition to being an economist, I am also a licensed real estate agent in the state of California. And then there's Bitcoin and other cryptocurrency, which everyone is still trying to figure out. If you want a more in-depth discussion on what the risks are for investing in Bitcoin, check out our recent video on the topic, which I will leave a link to in the description down below. Looking at the time frame for each of these, for financial goals you want to achieve in less than 1 year, a high yield savings account would probably be the best place to be in. On the opposite end of the spectrum, stocks would be a good place if your financial goal is more than 5 years away. Bonds are going to be a good place to be in between those two. One final consideration would be dividend stocks, which can be a good hybrid investment, and we'll get into that shortly as well. So by now you might be wondering, why did I pick 5 years as the magic number that divides short-term and long-term? This has to do with something called the business cycle, which is something that you can use to your advantage to take on a bit more risk than you might ordinarily be comfortable with in the short term. We see it in economic data, and we see it in the history of the stock market as well. The business cycle is one of the big reasons there is more short-term risk in the stock market and other business ventures. One of the best visual examples of the business cycle would be the unemployment rate. Let's take a look at a graph of that over the last 50 years. Here you can see the rise and fall of the business cycle. When the unemployment is falling, that represents economic expansion as people are able to find more jobs. And when it is rising, it represents economic contraction as more people are losing their jobs. The economic contraction is what we commonly call a recession. This phenomenon is very cyclical. It happens again and again, from expansion to contraction and all over again, as you can see here in the graph. We also see this in the data for non-farm employment. As our population and economy grow, we see the total number of jobs grow over time. But along the way, we see the ups and downs of the business cycle as well. When economic declines happen during economic contractions before continuing its upward trend. We also see this in the stock market. This is a graph of the S&P 500 over the last 50 years, and those periods of contraction and expansion can be seen over its history. Now, here's where that 5-year number we talked about earlier comes in. I'm going to zoom in a bit on the last 30 years of the S&P 500. Here we see the dot-com bubble that burst in 2000, and it took just over 7 years for the S&P 500 to fully recover to its previous peak. Here we have the housing bubble that burst at the end of 2007, and it took a little over 5 years to fully recover to its previous peak. What you have to realize in stock market investing is that no one has a crystal ball. There's just no such thing. No one knows what's going to happen in the stock market tomorrow or the next day or the next year. The 2020 pandemic showed us how rapidly things can change and send the economy and stock market into a steep dive in a short amount of time. There are very few people on this planet that can consistently beat the S&P 500 every year. So if you don't know what's going to happen in the stock market and you need to put your assets to use in less than 5 years, stocks might not be a good place to put it. You might want to consider government or corporate bonds. But if you don't need to tap into those investments for more than 5 years, then you can afford to wait for the market to recover even if a recession comes along. That's why it's important to know your financial goal so you can pick the right investment to get you there. Keep in mind, these are just guidelines that come from a more traditional style of investing and financial planning. Some people like to take on more risk. After all, there are people who trade stocks on a much shorter time frame than 5 years. But if you do that, you need to understand the risks that you are taking and be comfortable with the possibility of taking losses if things don't go the way you hope they would. For our final word on the subject, there's the dividend stock or fund. Some stocks pay out dividends over time, usually on a quarterly basis, regardless of whether the stock is moving up or down. Something that I have invested in the past is the Vanguard High Dividend Yield Index Fund with ticker symbol VYM. Based on the current share price and dividend payout, the yield is close to 3% annually, which is almost twice as good as the current yield on the 10-year Treasury note. I'm not endorsing this fund. It's just something that I've invested in the past. I'm familiar with it, and it makes for a good example. Something like a dividend stock can be part of a hybrid strategy because you stay in it for the long term through the ups and downs of the business cycle. But in the short term, you're going to get a steady stream of income each quarter or other frequency to meet your short-term needs. Keep in mind, however, that dividend payouts are not guaranteed and can be cut completely if the company paying out the dividend is not doing well and may need the assets for themselves. So you do need to be careful which stocks or funds you're picking to pursue this strategy. And that's going to do it for this classroom episode on long-term and short-term investing. I hope you found this information useful. Please give it a thumbs up and share it with others to support our channel. If you have other topics in investing or economics that you'd like to see in a future classroom video, please leave that in the comment section below. If you didn't find this episode useful, go ahead and give it a thumbs down. And let us know in the comment section below that only a fool follows historically reliable investing strategies, and that we should all just look at the Wall Street Bets Reddit group and bet our homes and life savings as if we are playing poker in the wild, wild west. Either way, I'll see you in the next video.